So we're on learning objective 4, the reporting various income items. And these are various income items. These will be your unusual and infrequent gains and losses, which this video will be about. And then we'll get to, I'll do separate ones on the discontinued operations and non-controlling interest and earnings per share. So before we get into this, I know I talked a little bit before about the what gets included on the income statement, and we're using the modified all-inclusive approach. And so just to think about it in sort of a chart-like terms, you've got your primary business, that's the ongoing operations, and you have your, and that's really the part of your income statement that has the, your operational income. So your revenues minus your expenses gives you your income from operations. Then we have the peripheral ones that were reported as other revenues and gains, other expenses and losses. These are part of the business, but they're not what they do for a business. So the interest revenue, dividend revenue, gains and losses on sale of equipment. Then you've got a separate category. These are all sort of recurring and dependable things that are ongoing. Then you've got this added other category of non-recurring. And this is broken into two parts. You've got your discontinued operations, which we're going to report as a separate section on the income statement that we'll get to when we do the discontinued operations. And then you've got these other non-recurring things that used to be, well, some of them used to be categorized as extraordinary, but that category is no longer allowed. But these would be things like insurance proceeds from storm damage, or damage to a warehouse when a meteor lands on it, something like that. They're non-recurring. You don't think they might happen again. So these will also, at this point, be reported as other revenues and gains and other expenses and losses. And then these have a separate section on the income statement. Okay, so why did you think about things like this, and why are they reported? Non-recurring items, they're generally given less weight by analysts because they don't indicate the future performance of the company. But then I love this, the cockroach theory. If you've ever had an apartment and you see one cockroach, is that the only one? No, it's not the only one. So over time, companies with these large, unusual charges end up having more negative stock performance. So they do give them some weight. It's not like they say, oh, well, it's not operational, we'll just totally ignore that. Okay, so let's get to the unusual and infrequent gains and losses. And what do we mean by unusual? Well, they're a bit abnormal. They're incidentally related to the company operations. And so examples of these would be your various losses and write-downs on receivables, inventory, your gains and losses on the sale of equipment, and things like that. Those you're fairly familiar with. The other thing that's included here you may not have run into are what's called restructuring charges. And these occur when a company is changing, it's reorganizing itself. So maybe it lays off a bunch of employees, it maybe has to close in some facilities, there would be severance pay involved, and there might be relocation costs. So these are all restructuring charges, and they have to be expensed as they happen. That was not the case in the past, and companies did use that to manipulate their income. So now those just have to be expensed. Effects of a strike, and gains and losses from the paying off debt early. That would, if you repay a bond issue or you repay a note, gains and losses there would be in this category. And then you have your gains and losses on the floods, the fires, the earthquakes, the meteor strikes, and all of that that would be included in your unusual and infrequent gains and losses, and gains and losses on the sale of your marketable securities, not your trading securities. will all be included in other revenues and gains and other expenses and losses. So the restructuring charges I want to go back to for a minute. They happen fairly regularly. There were a lot of them back in the 80s and 90s, and that's when FASB changed how they did things, because companies at that point were able to defer a lot of these restructuring charges, which meant that they could release those costs into income and really be manipulating their income. So the Securities and Exchange Commission, that's when they said, yeah, we're just going to expense all of that, and that reduces the opportunity for companies to manipulate their income. The other thing, what about extraordinary items? Where did they go? There used to be a category of extraordinary items. That would cover things like earthquakes if you lived in an area where earthquakes were rare, the meteor strikes, the really weird things that would happen. Things like maybe the government expropriates your assets. Those were previously considered extraordinary, and that was a separate category that would be reported along with discontinued operations. These are no longer extraordinary. FASB had what was called a simplification initiative to reduce the cost and complexity of the financial statements. And extraordinary items, it took a long time to really say, oh, okay, is this extraordinary, and to classify them and to justify it, and so the FASB finally said no more extraordinary items. And that goes along with international standards, who never have allowed extraordinary items. I guess one of the final things with that was 9/11. One might think that would have been considered extraordinary. And initially, the Emerging Issues Task Force of FASB meets to, whenever something like that happens, to determine, oh, okay, how are we going to account for this? So they met after Katrina, they meet after big storms, and say, okay, how are we going to treat this event? And initially they said, oh yeah, 9/11, that's really extraordinary. But then a few days later, they changed and said, no, it's going to be treated as, categorized as other expenses and losses, not as an extraordinary item, because they were afraid that all the companies, it was, the economy wasn't that strong then, the airlines were already in trouble, and they thought that most companies would just glom everything into extraordinary that really were not related to that incident, and it would distort the usefulness of the financial statements. So we don't have that category to worry about. So just about anything that's not a usual operating expense or revenue is going to be classified as other revenues and gains or other expenses and losses.